Hi, I'm Larry Kirshner. I'm a partner with Arch Capital Solutions. Our company helps HOAs find loans. We're HOA loan experts. For those of you who joined us in the first video, thank you, and thank you for coming back to our second video. This is the second in a three-part series on HOA loans. In this part, we're going to actually start talking about things that you, as the HOA board or financial or other type of partner, need to think about before beginning the process. Let's talk about the next steps in the HOA loan process. The very next thing that a board needs to do is to begin circulating throughout the community the concept of an HOA loan. You're going to need the community's support in order to successfully borrow. So it's smart to start communicating the intent with members that you intend to borrow and the purpose, what you're going to use the loan proceeds for and why you want to borrow, and the details of the mechanics of a loan, how a loan works. It's smart to start circulating this throughout the community to get a consensus, to start building consensus for a loan. The board also needs to begin thinking about, do you want to structure this as a special assessment or a dues increase? Each has their place and each has an advantage or a disadvantage. Those are things that the board needs to begin thinking about early on. And in talking about an HOA loan, I think it's wise to talk about both the advantages and the disadvantages. The advantages are funding certainty. You know that if you borrow and if you're approved for the loan will be funded, and it will be funded on a certain day, and the money will be available for the HOA to use based on the terms of the loan, as opposed to an assessment where people tend to pay on their own schedule. They don't always pay on the date certain that you're hoping to have funds in. HOA loans currently have pretty favorable terms. As a matter of fact, HOA debt is oftentimes more attractive than individual debt. So HOAs can borrow typically longer term on fixed rates if that's preferred, and receive much more favorable pricing from financial institutions than some individuals can. The interest cost is spread over time. Again, another advantage of a loan. It's not as though you're paying the interest all at once. And because you have funding certainty, you can facilitate quick repairs. Repairs, of course, can be made immediately. Pre-inflation pricing is important in some parts of the country. We recently were working on a transaction on the West Coast where construction inflation is running at twice the rate of the U.S. inflation. So it was important to think about locking construction prices in before these construction-related inflation sets in. Debt can be transferred on sale. If structured properly, a homeowner can sell their home and negotiate or demand that the buyer continue with their loan payments as opposed to making the loan due on sale. Or it can be due on sale. It can be flexible in whatever seller and buyer agree to. And participation in the loan can be structured as optional. And by that, what we're saying is, again, depending on the structure, a homeowner can make an upfront payment for their pro rata share of the assessment and choose not to participate in the loan, or they can choose to participate in the loan. It would be their choice. Now, again, no conversation is going to be complete without talking about disadvantages. Payments on the loan are going to continue until the debt is extinguished. Make no mistake about it, banks, financial institutions, lenders like to be paid back, so they will want to be paid back, and the payments are going to have to continue to service the debt until it reaches a zero balance. Borrowing can be a laborious process. You all are volunteers, there's no doubt about that for the most part, and applying for a loan can be a very lengthy and intense process. Your monthly assessments to members may increase unless you have a lot of fluff in the budget. You're going to probably have to increase assessments in order to service the debt. There will be HOA loan related costs, whether they're legal fees, reserve costs, inspection costs. There will be some costs associated with borrowing. Impairment of future borrowings. Typically, when an HOA has debt on their books, it's very difficult to take on additional debt until the initial debt is extinguished. So if an HOA has a loan on their books from 2 or 3 or 4 years ago and they need to borrow again today, what we see most often is the new loan will consolidate the old loan into one brand new loan that is an aggregate of both amounts. I know that's a mouthful, but essentially no lender wants to have another lender be in a more senior position than they are with respect to an HOA loan. So the original loan is either going to have to be paid off or consolidate into a new borrowing if an HOA wants to borrow again in the future. Default is problematic. So if an HOA is not able to service their debt, it gets ugly because, again, financial institutions are going to want their money back. So default is something that we never want to talk about, but we need to be aware of. So after deciding that we are going to go forward with the loan, it's smart for an HOA board to assemble a team and start to gather bids. The team needs to look at, typically it's a committee or a part of the board. How large is the project? Do you need a general contractor? And are you going to need permits, approvals, and insurance? Are you going to need an architect, an engineer, and a project manager? Who's going to be on the team that starts to look after the loan and measure it? You need to form a preliminary budget. So the HOA board needs to start thinking about what's the appropriate loan request versus the amount that you have in reserves, or the amount that you can raise just on your own. You need to think about sources and uses of a loan. So obviously the sources are going to be a loan. If you have X amount, what are you going to use that money for? It needs to be very clearly laid out and spelled out. And more importantly, plan for repayment. So how much are you going to raise dues by, and how will that service the debt, and for how long? Once everything is in place and the board knows they're going to borrow, they seem to have pretty good consensus from the community, the board also needs to obtain and document approvals. So before actually applying for a loan, it's smart to know, does the board actually have the authority, the legal authority to enter into a loan? Or do you need to go to the community for approval? Do you have the authority to pass and levy a special assessment? How is it going to be paid for? What are you going to do, and what are you going to implement? And this whole process needs to be documented in minutes. So each step you take, you want to document in minutes, so everything has a record of what the board is doing.